Hello and welcome to my channel. Today we're going to look at the yield curve. Specifically what it is. It's been commonly used as an indicator to predict recessions. We're going to look at how it can do that. We're also going to look at the effect on big banks, specifically one of Warren Buffett's largest holdings. Actually, it's his second largest holding. But to understand the yield curve, we first got to go to the bond market. So let's go take a look. So to understand the yield curve, we first have to look at long-term rates and short-term rates, and the yield curve is just the difference between those two rates. So I have a graph dating back to 2005 on the yield for 10-year treasuries and the yield for 2-year treasuries. So if we look at that specifically on the 10-year yield, the 10-year yield was in 2005, 2006, roughly between 4 and 5%, and during the financial meltdown in 2008, the long-term yield fell. And if we go back to most recently, the yield on long-term treasuries, or the 10-year, is roughly around 1% right now. And it is gaining momentum, has just recently broke above 1%, and it looks like it might go higher. But if we just understand what drives the yield on 10-year notes, generally driven by expectations on the economy, economic growth. Investors will buy and sell bonds based on their expectations. They will buy and sell bonds based on inflation expectations. So if we look at 2019, roughly, the yield on the 10-year fell from over 3%, below 2% prior to the COVID crisis, and then all the way down to 0.5% in the peak of the COVID crisis. So what drove that? Investors on Wall Street, bond investors specifically, they expect an economic slowdown. They will go to the bond market and buy bonds. Bond prices go up, and to compensate for the higher bond prices, interest rates fall. So prior to 2020, long-term investors were betting that an economic slowdown was coming. So they bought more bonds, moved money into more bonds, and interest rates fell. Short-term rates, on the other hand, are driven by the Federal Reserve. The Federal Reserve will establish targets, commonly known as the federal funds rate, and they will go to the bond market and buy and sell short-term securities, such as the 2-year note or other notes, to reach their target. So if we go back and look at what happened prior to 2008, the Federal Reserve was rapidly raising rates, right? So right before the financial crisis, they rose rates something like a dozen times, and short-term rates went up. So Federal Reserves control that. They go to the bond market, buy and sell bonds to get to their established target. Now, prior to the 2008 meltdown, the Federal Reserve started cutting rates. So they went to the bond market and started buying bonds, driving interest rates lower. So for most of the last decade, short-term rates stayed pretty low until roughly around 2017. Federal Reserve started raising short-term rates up to roughly about 2019. Then they started cutting rates again, and of course during the COVID crisis they cut them rapidly to zero. So short-term rates are close to zero right now. If we look at the behavior between the Federal Reserve and bond market investors, we can see a disconnect in two places. So if we look at prior to the 2008 meltdown, the Federal Reserve was rapidly raising rates. Generally, the bond market will follow course, and we would expect long-term rates to go up also, but they didn't. They didn't go up as rapidly, because the bond market really didn't believe that economic growth was a threat. As a matter of fact, they were probably expecting an economic slowdown. So short-term rates rose rapidly, long-term rates stayed relatively the same, and roughly in 2006, short-term rates went above long-term rates. So there was a real disconnect between long-term investors in the bond market and the Federal Reserve. You can almost say the Federal Reserve pulled the trigger in the 2008 meltdown. Maybe not the cause of it, or maybe the cause of it, but definitely pulled the trigger. So when there's a disconnect between long-term investors and the Federal Reserve, short-term rates can rise above long-term rates, and that's called an inverted yield curve because short-term rates are greater than long-term rates, and that number becomes negative. So, and that happened again in 2019. If we look at 2019, long-term investors and the Federal Reserve had a disconnect. So the Federal Reserve started raising rates in late 2017. Long-term yields didn't change that much. Matter of fact, in 2019, after the Federal Reserve started cutting rates, short-term rates rose above long-term rates. Yield curve inverted again. And a lot of people, it's common that you use the yield curve as an indicator on Wall Street, and when it inverts, and it inverted right here, that's going to indicate a recession, and it inverted here in 2006, that's going to indicate a recession is on the horizon. Not all the time. It's not 100% accurate all the time, but it can mean that a recession or an economic slowdown is coming, mostly because long-term investors come together in the bond market. There's millions of people making decisions, and they didn't believe what the Federal Reserve was doing, and they were expecting an economic slowdown. So long-term rates didn't go up as much. Short-term rates rose rapidly as the Federal Reserve went to the bond market, sell bonds to reach its target short-term rate. So when there's a disconnect between long-term investors in the bond market and the Federal Reserve, the yield curve can invert. That's when two-year treasuries, the yield on two-year treasuries become higher than the yield on 10-year treasuries, and that's unusual. So long-term rates are usually always higher than short-term rates unless there's a disconnect. So we've seen that happen twice so far in the last 15 years. So what does this mean to big banks? So big banks make money on interest income, and interest income is driven by this gap here. So they loan money out based on long-term yields right here, the blue line, and then they take in deposits and pay interest on deposits based on short-term yields. So that gap just recently started to grow, and long-term yields rose above 1%, and it has some upward momentum. Short-term yields have stayed relatively the same. So if we look at interest income on big banks, we can expect that interest income will go up and drive big bank earnings. Warren Buffett's second largest holding is Bank of America. In the summer of 2020, he purchased another 2.1 billion shares of Bank of America. He has more than 11% of the company, with permission from the SEC to purchase up to 25% of the company. And it may be driven by this gap right here. During the COVID crisis, the government put a lot of money in the economy, several $billions. So long-term rates, as we can see, are starting to rise. And that may be because inflation expectations are changing. With all the money pumped into the economy during 2020 and probably in 2021, we can expect inflation to go up. So long-term investors basically are selling bonds. Bond prices will fall, and to compensate for lower bond prices, yields on the 10-year will rise. And as that gap gets bigger and bigger, right, interest income in the big banks, specifically Bank of America, will go up. Again, the yield curve is made up of the difference between long-term rates and short-term rates. So as we look at this, the 10-year yield minus the 2-year yield, that gap looks like it's going to grow substantially. So let's go take a look at the yield curve itself. Here's a graph of the yield curve. So it is the 10-year Treasury yield minus the 2-year Treasury yield. And we graphed it dating back to 2016. If we go back to the fall of 2019, that yield curve inverted, meaning it went negative. 2-year yields rose above 10-year yields. And that right there is the disconnect between long-term bond investors and the Federal Reserve and interest rates, and it indicates, or it can indicate, not always, that a economic slowdown is on the horizon. And if we look at the yield curve, what it's doing in 2020, it has started to go higher. It's going higher quite a bit. It's got a lot of momentum on the upside. So the larger this gets, the higher this yield curve goes, it means that banks are going to make more money on interest income. So, and again, it may mean that investors on Wall Street may start moving a lot of money into big banks because they expect inflation expectations to go higher, longer term rates to go higher, and that yield curve also to go higher, or the gap between long-term rates and short-term rates. So we're starting to see a rotation into some of the big bank stocks recently, as we can see by their price movements. Their price movements have moved substantially over the last month, so that may be driven by these expectations. But there's other reasons to buy the big bank stocks, which we're going to take a look at. I am at the cash flow statement of Bank of America. So I want to see what they are doing with their cash, what they have done with their cash over the last 3 years. So if we take a look under repurchase of common stock, if we go back to 2018, they purchased over $20 billion worth of common stock, and in 2019 they purchased over $28 billion worth of common stock. So that's more than 600 million shares in 2018 and 2019. 2020 they purchased $14.5 billion of common stock. Then they were cut off by the Federal Reserve. They could not, because of COVID, repurchase any more shares. The Federal Reserve put a stop to it to all big banks to ensure they had substantial capital for any economic fallout. So Bank of America has been buying back a lot of shares, and a lot of the big banks have. So as the yield curve goes higher and higher, interest income goes higher, I will expect in 2020 that this trend will continue. And 600 million shares every year is a lot of shares, and I can see the supply of bank shares going lower quite a bit, especially when Warren Buffett can purchase up to 25% of the company. He already has 11.5% of the company. If he takes that up to 25% of the company, then I would expect there would be a substantial squeeze on Bank of America and the stock to go higher. So that's it for the yield curve and big banks. So if you like the content, please hit the subscribe button. Send me your comments. I would love to hear from everybody, and hopefully we'll meet again shortly.